Firstly, I'd like to thank the ATA for inviting us to present at the Technology and Maintenance Conference. I would also like to thank the sector for the way in which you've continued to operate and support the community during COVID. When we last spoke, Peter and I were working at one of the big four professional services firms. Peter and I have recently made the decision, which we're very happy about, to move to a new company, Ryan Tax Services. Ryan is the largest non-audit tax firm in the world and has a strong reputation for helping clients in the transport sector. Peter and I will address three things in our discussion today. Firstly, the changing fuel tax landscape. Secondly, the ATO expects you to do more when you're claiming credits. We'll address an alert they'll publish shortly. And thirdly, and finally, transport companies are being sold the dream regarding fuel tax compliance by GPS providers and certain advisors. However, this has led to over-compliance and errors, which will be addressed by the tax office. We will address a simple methodology which will be shortly endorsed by the tax office and is being currently used by our transport clients across the country.
Yeah, thanks Chris, and hi everyone. The first topic for today is to discuss the changing fuel tax credit landscape. You could be forgiven for concluding that I do bang on about fuel tax credits. But there has been a changing landscape since 2012 when we were successful in the Linfox case, and you will remember that. Prior to that, the transport industry only knew one FTC rate, or diesel fuel credit rebate. That is the on-road rate, which is currently 16.5 cents a litre. Even today, internal accountants, CFOs, etc. focus their attention on compliance and ensuring that GST, income tax, payroll tax, etc. is remitted correctly to the taxing authorities. Less attention seems to be focused on the obvious, and that is getting cash back that you're entitled to from the various government authorities, and in this particular case, fuel tax. As you know, we have been very active in ensuring that you maximise entitlements within the confines of the legislation. In the early years, the ATO conceded that they were wrong in how they interpreted the law pre-Linfox and didn't challenge the decision. In fact, they issued safe harbour rulings, etc. to help business understand their entitlements. We, of course, pursued entitlements based on our interpretation of the law and, where necessary, pursued support by way of tax council opinions. If the ATO disagreed, then they did sometimes, then we took appropriate action. Example, the toll road litigation, which you probably all know about. In recent times, however, the ATO has identified a number of overclaims by taxpayers who have received advice which has been based on a misinterpretation of the law or a misinterpretation of the ATO guidance. The advice has been provided in some cases by those who do not have a tax technical background and are not tax agents. They and their clients have relied on algorithms and software without applying common sense to the results. As a consequence, the ATO has been clawing back overpaid FTC refunds and imposing significant penalties. We have helped mitigate the impact in a number of cases. As a consequence, the Tax Office will publish a taxpayer alert entitled Fuel Tax Credit Overclaims relating to GPS and telematics technology. This is an unprecedented step for the Tax Office and something I haven't seen in the past 20 years of advising clients on fuel tax and prior schemes. Critically, the alert shares the Tax Office's concern that the approach taken by certain advisors and GPS providers has led to overclaims of fuel tax entitlements. Taxpayers are being invited to approach the Tax Office if they have been impacted. However, we would strongly urge that you obtain a second opinion before doing so. Further, we have seen a number of voluntary disclosures made which are either unnecessary or they overstate the disclosure. It is important to review such a disclosure before submitting it to the ATO, but also take the appropriate steps to best mitigate any potential interest and penalties. That is, it's not the best approach to let the advisor who overstated their claim submit the disclosure.
But how do you know if you've been impacted? The Tax Office sets out in this document some of the common errors, but in short, you should be concerned if the off-road percentage advised by your advisor or GPS provider doesn't align with your understanding of your business. By way of example, we'd expect the following off-road percentages to be potentially overstated. Line haul, over 3.5% off-road. Local distribution, excluding port work, over 15% off-road. Port carriers, over 25% off-road. Secondly, the off-road percentage was simply shared with you and you were not provided with the advisor or GPS provider's analysis. This black box approach, which Peter mentioned before, of taking your GPS data and coming back to you with a substantial refund without verification, is something the Tax Office is very concerned by. Thirdly, the Fuel Tax Act is complex. If the fuel tax work has not been completed by someone with understanding of the Fuel Tax Act or someone who's a tax agent, you should be concerned. The work in this space is tax advice, and something as simple as what is and isn't a public road is deceptively complex with many grey areas. Port roads, rest areas, shopping centres. If you're concerned after hearing this, we'd urge you to speak with Peter or myself to ensure that your advice you've received is reasonable. Problematically, overclaims are required to be repaid in full, along with interest and penalties, which may be up to 100% of the shortfall amount. However, there is some good news. The Tax Office at the same time will issue a document which publicly endorses the use of a deductive methodology for the transport sector. We've found this is less complicated and results in an increased claim for a lot of clients. There will be no need to necessarily rely on GPS data, auxiliary equipment burn rates, and other information to prepare monthly or quarterly claims. We're seeing businesses over-engineering their monthly calculations and paying unnecessary fees for the privilege. The deductive methodology is not only aligned to the legislation, starting with the fuel you've acquired, but is a simplification of the claim process. This also results in further refunds, particularly for those operators that have missed fuel or understated their entitlement for fuel used in powering auxiliary equipment on heavy vehicles, i.e. the refrigerated transport sector. The Tax Office initially is expected to affirm the deductive methodology for companies that claim less than $10,000 per year, but their ultimate goal is to expand this to other taxpayers. We are happy to help you with exploring this immediately.
We look forward to continuing to work with the transport sector and are available to be contacted during TMC and after on our mobiles. What are the three takeaways here? Like it or not, the landscape for fuel tax credit is changing. We are moving more into a tax risk management environment, and we would strongly recommend that you review what you've done and review in the current landscape. 2, the other key takeaway is that businesses, as Chris mentioned, are over-engineering their FTC compliance and paying for the pleasure, with the irony being that the more complex, the more chance something goes wrong. Lastly, and most importantly, clients are calculating their off-road usage monthly. This is clearly over compliance, and there is no tax office obligation to do, and therefore unnecessary.